Cathie Wood out with an unbelievable prediction for Tesla stock here today, folks. They had her on a day when Tesla stock's down big, and we're going to hear why she believes that Tesla is going to, yes, $2,000 by 2027. Okay, we're going to hear her out. As somebody that's been a Tesla bull for a long, long time, I want to give my perspective and share my opinion on if I think that's a realistic possibility or that's a pipe dream and all those sorts of things. And I'd love to hear your guys' comments in the comment section as always. Okay, second video for me to react to up here today. It's a buy one get two free for you guys. We're slow walking into a recession. I want to hear what they have to say in regards to that. It's an interesting subject. And the third video we're going to react to is nearly every data indicator suggests an impending recession. So we'll react to that one. I kind of give my perspective on that. And by the way, it's interesting, right? I've always felt like this for years as far as CNBC. It's like when the market goes down, it feels like they have like more people just on to give bearish cases, and when the market goes up, it feels like more of like bullish cases. I don't know if I'm ever in New York, I'm going to try to talk to some of the producers and whatnot and find out how they do their shows, because I know some people are way predetermined, but like it almost feels like, oh, the market's down, let's call up some people that have some bearish stances, and oh, the market's up, let's give some bullish stances. I don't know, man. Anyways, appreciate y'all. Thanks for joining me as always. 25,700 plus subscribers now on the channel. I appreciate each and every one of you. And also, I'm making my moves in less than 24 hours in the Patreon portfolio. Make sure you join us in there. That is pinned comment down there. You can see what stocks I'm buying and selling tomorrow in there, okay? And I might also be taking away that $10 tier here very soon, so just do keep that in mind if you want to join that tier. You know, I would likely take that away in the next, I would say 7 to 10 days. And then whoever's already in that tier will be able to stay in that tier, and then we'll probably just have the $19 tier after that. All right, guys, let's get into this.
It's top holding in her ARK Innovation Fund, her flagship fund, and Cathie Wood joins us now exclusively. Cathie, it's so great to have you on the show. Thanks for being with us.
Thank you, Morgan. Happy to be here.
So much to discuss with you, but I do want to start with Tesla. Your reaction to those results we did get yesterday, and specifically the fact that the operating margin dropped pretty dramatically to 11.4%, certainly in focus for trading today. Does this change your outlook or your thesis around Tesla?
Not at all. In fact, curiously, we want Tesla to scale its units because each one of them now represents the potential for a robotaxi and a robotaxi fleet. Now, Elon says it's possible that he could launch that fleet this year. We think it's more like last year. But the robotaxi fleet is really going to be, or the robotaxi service is going to be, from a margin point of view, more like a SaaS business. And so we think that it's very smart to maximize units because they have so much option value now.
Yeah. I mean, but we've been hearing about the robotaxi fleet for some time. There's a lot of regulatory barriers to all of that, and certainly technological barriers involved too. So how soon can we actually see that realized? And given the fact that you tweeted earlier today that you've got a new valuation assessment of Tesla coming out, how does that fit into your price target for the stock going forward?
The price target for our stock, and I think it's just hitting now, for 2027, because we do have a 5-year investment time horizon, is our expected value is roughly $2,000, and that's within a range of $1,400 to $2,500, our bear and bull case.
So let's get this right. The bear case is $1,400? And the bull case is $2,500. Holy smokers, that ain't no dang joke. Oh my gosh. Okay, I'm gonna let her finish up here, and then I'll get in here.
Now, just Morgan, on the regulatory side, I actually think regulations are working in Tesla's favor. For, I think, roughly 3 decades, the number of auto fatalities in the United States fell to the low 30,000 range per year. And they've turned around in the last 5 years and moved up to 45,000 plus. And I think the pressure is
crazy to think like that many Americans are just lost each and every year, right? 45,000? I mean, it's unbelievable.
On the National Highway and Transportation.
I would love it if someday we could get autos to a point like we do planes, right? I mean, like a plane crash, like people are like would be shocked by that, right? Oh my gosh, somebody died on a plane, like that's insane. It would be nice if we get to that place when it comes to autos.
Safety Association to change something. So it is looking carefully at Tesla's data. And during Investor Day, Tesla released some data that we don't think many people paid enough attention to. The most important one is that with full self-driving, a Tesla vehicle gets into an accident every 3.2 million miles. And that compares to one every 500,000 miles for the average car on the road.
Okay, so Cathie, hold on. Good afternoon.
Yes.
It's John Ford. I just want to clarify. Did you say a $2,000 per share price target? Tesla right now is under $200 a share. So
Yes.
even if you were to 10x that would be an over $5 trillion market cap. Is that what you're saying?
That is what we're saying. We think that the robo-taxi opportunity globally will deliver $8 to $10 trillion in revenue by 2030 and is one of the most important investment opportunities of our lifetimes.
Okay.
And I think one of the reasons for that is it is going to save lives. 80 to 90% of auto fatalities and auto accidents are caused by human error. And autonomous driving is going to take away the human error, we believe.
Yeah, humans are very bad at driving. We do know that. That is for sure accurate, right? And it's unacceptable how many lives we lose. And so it's going to be great when we can get, like I said before, like to an opportunity where, it's almost freakish to hear of somebody, a fatality in a car accident. Okay, so let's talk about $2,000. Let's talk about the robo-taxi opportunity. Do I think that's realistic? $2,000, 2027? No, I do not. I do not think that's realistic in 2027. I think it's possible someday Tesla can be there, maybe end of decade. I think it's a possibility, for them to go through its next 10x. But yeah, there's so many issues. Okay, first off, Tesla has to finish their technology, right? And they're going to have to get it to near perfection in order for the government to sign off on it, states, cities, to really, this to go huge, right? And then in terms of, all the vehicles being able to drive people around with no driver in it, that's all very time-consuming stuff, right? And then also you got to think, like, how fast does it take for that to take off whenever that does finally come? And it's not like it's going to all come at once. It's going to be a ramp process there, right? And I think there's going to be a lot of questions about actually profitability and margins the first few years when they do ramp it. So let's say robo-taxi opportunity, it actually starts to come to fruition, let's say in 2025. Okay, let's just use that as a number. Who knows? Some people may say it's going to be before that. Some people say it's after, whatever. Let's say 2025. When they do start to do that, I have a hard time believing that business is going to be profitable right from the go. I wouldn't be surprised if that business actually lost money, in substantial amounts of money, for years to go. When it first launches. And then at some day it will scale to enough size where they'll be able to start making money from it. It'll be a great thing. But it's hard for me to imagine that business being profitable in everything right from the go. I think it's going to be like many businesses, lose money at first to then end up making money, kind of similar to how Tesla built their business, right? It was a huge money loser for the longest time. As they got scale, then they got to profitability. So that's kind of my 2 cents on that. Certainly big opportunities, but yeah, I don't want to get too excited about $2,000 stock price in that's 4 years from now. Come on, man. I think Tesla has good potential over this next several years, but yeah, that's a bit much in kind of my perspective there. Okay, let's talk recession in these next two videos. Alrighty, let's get up.
Vertus and Alicia Levine of BNY Mellon Wealth Management. Joe, of course, a CNBC contributor. Tough day. I mean, the earnings not great, and the data's just bad. I don't know. You want to sugarcoat it? It's just bad data today.
It's recessionary. That's exactly what it is. Philly Fed is minus 31. The last times that Philly Fed was minus 31, 2020, 2008, 2001, 1991. I told you I was concerned about this week. The rhetoric that we heard from the Federal Reserve means they do not understand the environment that we're in right now. Auto loans, delinquencies are beginning to rise. What's the most important payment that you have? It's your car payment. We saw it represented today in the state.
Sir? I think a house or rent comes before that. In all due respect, sir, I think we forgot one. Okay, car, yeah. Car's definitely up there, okay? But not more important than the roof over your head, let's put it that way. And for some folks, actually, to be honest, cell phone is above car payment, okay? Because people are like, well, I could lose my car, I could always Uber around on my phone. But I don't have any phone. What am I going to do in life? Oh, my God.
Statistics for housing, we see it universally. The economy right now, leading indicators, negative territory. The economy as we sit here today is probably in a recession. Is it statistically in a recession? Maybe it's not. But it sure feels like for consumers that that's exactly where we are. Look at the market. Where's oil? Oil is $1.50.
So does it feel like recession? Well, let me tell you, for me, I try to go to Starbucks at 11:15 a.m. It's not even supposed to be busy for Starbucks at 11:15 a.m. Like, come on, man. We shouldn't be at the lunch rush. We shouldn't be at the breakfast rush. Line was so flippin' flapjack and long, I thought they were giving coffees for free. I dipped out of there, and I was like, oh, let me go to Dutch Bros. Went to Dutch Bros, it was twice as bad. I'm like, dude, I do not have 45 minutes to spend waiting for a flippin' flapjack and coffee. So I came home, okay? So that you see going on, right? Restaurants still packed. Lower ticket purchases still doing very well. It's really big ticket purchases that have really showed weakness. Homes, autos, furniture, luxury goods. That's the real areas we've seen real weakness in the economy. But in terms of overall economic weakness, I wouldn't go that far. It's mainly for the stuff that you have to take out a loan for. That's where we have, people don't have a problem paying $7 for a latte. People don't have a problem spending $50 or $100 at the restaurant. It's, taking out a loan for $50,000 to buy a car or $500,000 to buy a new house.
Above the level before the announcement of OPEC. That's on demand concerns. Look at gold. If we have a chart of gold this week, you'll see that you had a significant dip down to 1980. They came in, they bought it. Why? Because it's the disinflationary proxy, and the 2 years moving down again. We've got a problem economically.
Energy's weak, Alicia. Tech is weak today. Discretionary is weak. What do we make of it?
So we're slow walking to the recession. It's not the boom that we thought it might be during the banking incident. I'm going to call it an incident and not a crisis, because so far it's not a crisis. But we're slow walking because of the contraction of credit. And the sectors that have got us to this point, with the S&P up 8% and NASDAQ up 16%, are really the sectors that are next up for some weakness here. Because ultimately, you cannot have a contraction of credit in small, medium-sized banks and not have it affect the real economy. Now, I still think the Fed hikes in May. It's all, the market's giving it to them at this point. It's 90%, 88% chance they're going to do it.
Not giving them anything more than that, though, right? If you look at the bond market.
Not giving them any more than that. But if there's a sort of linear progression downward in the real activity, the Fed is not going to cut, because this is what they wanted, and they're going to get it.
Tesla's been
absolutely no reason for the Federal Reserve to raise rates. Now they're at a point, you look at true-flation numbers, we're at about 4.3, 4.4% true real inflation as of right now, right? Fed funds rate around 5-ish. There's no reason to keep raising when Fed funds rate is above where actual inflation is right now. They probably should have gotten out there faster and more aggressively when they were actually raising rates, to be honest, to get out in front of inflation and to be up at a 7-8% number when inflation was a 7-8% number. But they chose to kind of go slow, and it kind of elongated the whole process, right? But it is what it is. I'm glad I don't have their job. All I'm saying is, there's no reason to keep raising when you're already at inflation number that's lower than Fed funds rate. Doesn't make sense.
All day.
It's down 10%.
How much of an issue is that? On a number of different levels. I mean, it's a $500 billion market cap company, so it's weighing on the NASDAQ. It weighs on sentiment in some regard. Now you have worries about price wars in autos. You look at Ford and General Motors, we could throw those up too. It's not just a Tesla.
Price wars. Can you say deflationary?
Story today as it relates to that. Demand fall off, you try and raise demand, you cut prices.
So this is my concern. My concern is exactly what you're talking about, and I'm talking towards what's the earnings effect. It goes beyond Tesla. Look at AT&T today. AT&T is telling you that there's economic weakness when it's down 12%. Now, listen, You could say, well, what about D.R. Horton? Okay, D.R. Horton, it's a momentum play, it's low inventory. But the concern that you have right now as an investor, I've said this all week to you, the economic weakness that we're experiencing now was discounted by the market in the fall. That takes you to where you sit, approaching 4,200. What is not discounted is a U-shaped earnings recession. We are in the midst of the second consecutive quarter where you're going to see negative earnings growth. The calendar quarter that we're in right now will by far be the most intense contraction in earnings growth of the 3 consecutive earnings quarters that are going to be negative. We know there's going to be 3 in a row. You're in that. What happens from there? That's what the market has to price out, because the expectation is that you'll begin to come out of it. You'll get mid-single digit growth. And then on the other side in Q4, you're going to get the double digit growth. Well, we really need to see that. And that's what I think the complexity right now is in the market.
That is a shocking move. The AT&T move, I saw that today. I was like, AT&T down over 10%. Wasn't the flip and flapjacks going on? Seagate's actually a really surprising one too, about a 10% move. That's wow.
Is figuring out what the alphabetical letter for the earnings recession is going to be.
Yeah. Interesting. Okay, next one up here. Nearly every data indicator suggests impending recession.
Let's ask Jamie Cox. He's managing partner at Harris Financial Group. And Francis Donald is chief economist and strategist at Manulife Investment Management. Francis, let's just kick things off here. Weakening is the picture.
Weakening, and this is the game with macro. It's not about the level, it's about the direction. And for most of the leading economic data, unfortunately, we have both of those problems. Some of the levels of this deeply, sharply negative data is consistent not just with garden variety recessions, but some of the worst recessions we've seen. And we continue to see a deterioration in the data that matters. Now, we still get pushback, but jobs, they're still so high. Let's remember, jobs are the last shoe to drop when we're in this type of environment. So when we're looking ahead, unfortunately, just about everything that we have on our docket tells us a recession is coming. And if you're going to push back against that, which you can, you have to say, well, this time is different. And it just might be. But if you're an economist with numbers, it's really hard to look at the stack of data and see anything but a recession right now.
No, it's so fair. Main issue I have is this is a nice professional back look here. But listen, okay? Get something on that flipping flapjacking huge table, okay? You need something there, like a plan or a fake plan or something, get some marble stuff like I got. Like, I mean, it looks, it's a nice backdrop, but it just looks so lifeless there. It looks like they're about ready to pack up shop, man, for this investment firm and like dip out of here. I mean, there's just a whole lot of nothing.
So obvious and normal the way that this is playing out. I wish we would hear more from the Fed about it, not about employment and inflation and all the last places this shows up, but about the stuff like claims like Philly Fed and all the rest of it that's weakening. Now, let me just ask you this, Francis. One thing that is different from at least 2008, consumer balance sheets are in a lot better shape. So as odd as it sounds to ask the question, do you think households can somehow, bear a bad recession better than they might have been able to 15 years ago?
Well, they may be able to. And the other component is that we still have a significant labor shortage. We had significant mass early retirement. We may see a pretty sizable recession in growth data that doesn't translate as much to the labor market. That might mollify some of the challenges that we're seeing ahead. So even though I can look at this huge bevy of data that says, well, it's quite clearly a recession, certainly there are elements that may make this a little bit less bad. My question for the Fed is, what are you going to do when unemployment starts to rise, but inflation is still at 3 to 4%? We've been so inflation focused with their mandate. They may have to actually say, you know what, we're going to have to cut even with inflation at 3%. That's going to be very uncomfortable for them.
It shouldn't be, though. It shouldn't be. Like, let's imagine a scenario, okay? Unemployment's ticking up. Let's say it's later on this summer. And meanwhile, let's say, CPI's at 3.3, okay? And Fed funds rate's still at 5. Is nothing wrong with bringing rates down to 4 at that point in time, or 3.5. I mean, you still could be above the inflation rate. There's no problem with that. So, it's just, I'm like, they don't have to do that. But it's just like the Fed, I don't know, there's just this thought process, like they have to keep rates at 5% or above 5%. Why? Why when it's 3? You don't have to do it that way. You could easily bring it down at that particular time.
Great point. Jamie, let me turn to you because I feel like you're not as bearish, but you're also still in the camp of saying, like, obviously, like, this is going to happen, and the Fed needs to do something about that. So just, and Ken, I know, for instance, a lot of people like you yourself focused on AI trades and secular winners, but can that really transcend these macro wins, you think?
Well, the accumulating effect of interest rates or interest rate policy over the last year is really catching up with the data. I mean, the economy is really struggling, and that was sort of on purpose. I mean, that was the Fed's game, was to lower inflation. And when they slam on the emergency brake with Fed funds rates, we are seeing in real time what the effect of that is. And what I'm hoping is the labor market is actually strong enough to sustain us through the manufacturing piece of this, where the price is paid and the prices, received portions of this can actually become transitory because the Fed made it that way. So I'm hoping that we can get inflation to actually fall and actually have some type of, economic slowdown that will not translate into the hardest of recessions. But unfortunately, the further this goes and the higher interest rates go or stay for longer, the more the reality is the recession will be harder and longer and deeper.
Yeah.
So I do believe that you can trade through it, but it's not going to be an easy thing. And to add insult to injury, we're staring down the tooth of a debt ceiling debate, which is completely unnecessary. So we have a lot of things that are sort of already making it difficult enough for markets and the economy, and then add on top of it something that's artificial. You could get a very, very bad result in the next couple of months.
Jamie, why?
So it sounds really scary, but I can just tell you. So the stock market basically hasn't done anything for 2 years. Okay, let's assume that we have a recession here. Let's say the market still doesn't do anything for the next 2 years. That'd mean 4 years of the market going nowhere or down, right? I can tell you, you look at every single time period throughout history. If you ever got a 4-year span where stocks did nothing or potentially went down, it was a generational buying opportunity in that particular time. So I would say to folks, don't fear the market stagnating or not doing anything. And even if this market was stagnant for 4 years, believe me, there's going to be massive winners in that market as well and massive opportunities. Even in a market like that, right? There's going to be some that just don't do much, and there's going to be others. Look at where the Dow's gone this year. Look where ELF stock's gone this year. Look where the Dow's gone this year. Look where Tesla stock's gone. Even after today, it's still up 50% this year. Look at where the Dow's gone. Look where Meta's gone this year. Look where NVIDIA's gone this year. Look where the Dow's gone, right? And so just understand there's opportunities in any sort of market. And if you were talking about this scary scenario where, stocks are continuing to be down and out for another year or two, shoot, man, that's just like the best gift you ever got. That's all I have to say about that for investors.
Market, and not just the market. We see plenty of, corporate bond issuance. We see like risk on kinds of signs that look pretty good. So if people were looking at the signal from equities, from some of those things, they might say, you know what, it's just not that bad. And I can't understand that. I mean, things like jobless claims are so obvious, right? They're not hiding. It's out there in play. And it's not horrible. I don't want to overplay it. It's up, from 200 to 245,000 this year, but I don't think it's just going to go back down, right? Continuing claim. Why doesn't risk care more? Why don't investors care more about this? I honestly don't understand it.
Well, once the snowball of jobless, once the snowball of unemployment starts, it usually gets really bad.
Wow, way to go, CNBC. What a place to shut the video off. Man, you guys do something else on there. Okay. She's acting like, so confused. Why does the market care? Did you miss the 22 market, ma'am? Did you miss the fact that the NASDAQ fell like 37%, peak to trough? Did you forget when the S&P 500 fell 22%? I really think people forgot like 2022 happened. In 2022, the market got out in front of everything. It got way out in front of everything. It was 6-9 months in the future. And the weakness that are seen in earnings, like the market was already playing that game back in the summer of 22, fall of 22, before a lot of companies really started reporting weak numbers. They were way out in front of that. And now the market's getting out in front the other way, which if the market's right again, which it probably is, if the market's right again, you're going to see strengthening earnings for companies in the third quarter and fourth quarter this year. I think it's a realistic possibility for the biggest companies in the world. I think their margins are going to expand, their profitability, their revenue, everything across the board, but specifically with bottom lines and margins in 3Q, 4Q. And there's a lot of small cap companies that's the same exact situation. Their margins are going to get way healthier in 3Q, 4Q. Their profitability is going to get in a way better place. Cash flow. And I think that's what the market's seeing through. We won't know the answer though, right? We're, now companies are reporting their first quarter and they're in the second quarters right now. So we're not going to know the answer to this game for another almost 6 months. You got to wait. But don't be surprised if the market's right again, because it was right before. Who's to say it's not right again? I appreciate everybody joining me as always. Thanks for being here, folks. 25,700 plus subscribers now on the channel. Make sure you join us in the Patreon. That's going to be pinned comment down there, and get to see the moves I am making tomorrow in there. Less than 24 hours till I make my next moves in their stocks I'm buying and selling. Much love and have a great day.